Hey Trader Steven here with TradersPlan.com. It is Thursday, September 13th. I hope all is well. And one more day away from the weekend. So let's get right into it. We're going to look at the individual indices. We're going to look at the markets, and it's feeling very 2013-ish. And I'll tell you what I'm talking about here in a little bit. We're going to look at some individual stocks as well towards the end, some sector summary, but I think the theme today with everything so bullish is to just really know your exit, right? Know where that you are, it's not a matter of if, it's a matter of when the market takes a deeper pullback, deeper than a 3 to 5%, as we've seen right here. Do you have that plan in place? Because, there are times, old Steven, I used to get this feeling where just the market just can't go down, and you just feel like I have to buy something. You got that kind of euphoric feel without really knowing it. Now, when I get that feeling that the market's just going to take off without me, sometimes that's a warning sign. And even though, yes, the market might go up for a few more days, just sometimes it just means you just got to be cautious. I'm not telling you by any means to go out and sell anything, but know when the trade starts to unwind, when it starts to go against you, know where you need to get out. It's very simple. What's going on in the Nasdaq right here is it keeps pulling back to the 50-day moving average, and it's pulling back in big volume. Big volume on the distribution, not a lot of accumulation. Big volume on the distribution, there is good accumulation right there. But look at all this distribution right here. That's a ton of distribution going on. We've yet to see, we've had a couple of accumulation days in there too. This is, I believe, is going to be above average day, but we'll see. So, to me, as far as when I feel like I need to put some money to work, I'm not necessarily going to go out and buy an individual stock based on the pullback in the indice to support. I'll wait and see what the stock is going to do. But I might buy, if I have some cash I need to put to work, but I don't really see any individual stocks that I just have to have. I might go out there and buy a leverage ETF and say, okay, if support breaks, I'm out, and maybe you play it and see if it breaks out to an all-time high. And as if we can see by anything, you buy the pullback, and as it's breaking out to an all-time high, it's probably your best bet to take profits, right? You sell into strength, and buy the pullback. When you're dealing with indices. But this does feel 2013, and we're going to look at that chart here in just a minute, where it just can't go down. Same thing with the S&P 500. It's not that much of a different of a chart. You do have, but it's just not coming down to the trend line. So it's just, the market is very, very strong right now. So you want to make sure you take advantage of that, but don't get euphoric, and make sure you know where your line is on each individual position. And I recommend drawing your line on a position basis, not on what the overall stock market is doing, because stock market might pull way, way back, and you might have a stock just chilling, hanging in there, not really doing a whole lot. Now, it might not be going up, but that's showing strength that it is kind of bucking the trend by going sideways. So I recommend looking at your portfolio and picking a spot. I always say, okay, for me to be right on this trade, I'm going to pick a spot, and it shouldn't go below that point. And if it goes below that point, something's wrong. So find that point on your trades for your shorter term stuff. Obviously, your longer term stuff really doesn't matter. It's incredibly strong. Breadth is strong. But I do want to go back and look at the Nasdaq. And I want to go back a little bit. So just kind of remember this just grind, this pullback. The 20-day moving average is just almost not in play, and sometimes you can use the 20-day moving average for strong rallies. But I remember in 2013, I got spit out a lot because I was trying to use the 20-day moving average, and I should have used the 50-day moving average. And it's very, very similar right here, where it just keeps finding support in the zone. You can see one day it broke and found support. And one thing I think I did right on this time is it pulled back hard, and I didn't, think the sky was falling, because that's just what continues to happen. But, if we go back a little bit, let's just say we're looking at a 6-month chart, but let's just kind of pick a start, predefined range. Let me just kind of look at a January 1st, 2013 to let's just go to January 2015. That's fine. Just to kind of look at, okay, so you have 2013 is a very, very strong market. If you'd have stuck with it, you'd have done very well. But look, it's almost like the blue line. Actually, let me bring this in here. I think it'd be easier to take a look. So this is just the Nasdaq in 2013, and I feel like the market is very similar, where like it keeps coming down in distribution, and then it'll go out, and then it'll come down in distribution, and then it'll go back up. And the 20-day moving average is almost not in play, so it's a strong market, but they're not just super strong rallies. It'll go up 7%, pull back 3, go up 5%, pull back 3, and that's exactly what's happening right now. And I'm not saying that we're going to have another 30% year, but this happened in 2013, and it just continues to just grind its way higher. So you want to, when you see this, to me, it looks almost identical to 2013. Not a mirror image, but when it just keeps going up, pulling back 50-day, pulling up, going up, pulling back to 50-day. I mean, you can see it happen time and time again. Means you're in a strong market. So when this ends, which it will, and I have no idea how long, because again, we just continue to play the bull until otherwise. And you can see right here, finally, it had just kind of a more deeper correction. That didn't last long, and then it got back out of it. So I don't know how deep we are in the bull market, but you can, raise your stops. You can, and you don't want it too tight, but you can raise your stops to swing low points. Once you find that next swing low, you can say, okay, that's the point it shouldn't go under, and that's where I'm going to have my stop. And who cares if you have it right under? A lot of people say you don't want to put it in the obvious places. To me, that's exactly where I want to put it, and that's just because I don't want to, I'm not going to put it way down here and then risk this much. I'm going to put it right here, and I can always buy it back if it just whipsaws me out. So what, right? Because, whipsaw is going to happen, but the bulls are in charge, and that is for sure. Let's look at the S&P 500, Brett. What's there not to be bullish about? You have 70% of stocks above the 200-day moving average. Anything above 60 is bullish. It's not a straight line. It never is. But, that looks good to me. So there's broad participation. The market looks like, it's continuing to find support at that 50-day moving average. When the 50-day moving average breaks, which it might roll over tomorrow or Monday, I don't know. But that's when you have a character change. You've heard me talk about personalities. When the personality changes, that's when you need to be laser focused and pay attention to what has changed. And a lot of times, that 50-day moving average is being is close to being broken. You'll see a lot of these secondary indicators like breadth already rolling. So we're just not there yet. The Vix is getting lower. So if we look at the Vix, and this is something I looked at either a week or two ago. You can see I was drawing this, and this is just how flexible you have to be. To me, this looks like it was the VIX, the fear gauge, the amount of puts being bought, was going to keep heading higher, right? You got this curving. It looks like the base is starting to curl in the VIX. I don't make trading decisions off the VIX, but it's just that secondary indicator, that another piece of evidence to use. So I'm thinking it's going to head higher, and then it just kind of breaks the cup. And it's kind of heading the other way while the market continues to chug higher and find support. So it's hard to make a bearish case right now. If you had to make a bearish case, to me, you would only be making the case because the market just keeps going up. There's so interesting to me sometimes how everything on the news, trade wars, Trump, you name it, you can find something to be bearish about. The market climbs a wall of worry. That's why I do not make decisions on fundamentals, at least from an index standpoint. I might buy individual stocks based on fundamentals and technicals, but as far as the index is concerned, to me, it's all technicals. because all that piece of information that you can watch on CNBC, it's already in the chart. So why really try to rack your brain over what's going to happen? It's easier to react than to try to predict. And I asked to give me predictions all the time, and I just give the same answer. I don't know, and that's something that, you know, I've been an IBD follower for a long time. They don't teach, you know, trying to predict. You react to the price action. You take it day by day. You try to be as flexible as you possibly can, and you might, you know, stick your flag in the sand saying this is the way it's going to be, this is where it's going to go. But if something changes the next day, you got to be willing to pivot with it, and not go down with your ship. That's for sure. So I think that I really am kind of doing this on the fly. Definitely had some distractions today. So I think that one thing I want to look at is the dollar, because it continues to, you know, come back down into this support zone, and that is okay. That is completely okay, because it just made such a big move. I'd almost rather look at the UUP. Let me look at the just a raw chart of the UUP. Excuse me for a second. So now it's breaking the 50-day moving average right here. You know, I kind of had a grind higher pop. I'm very interested to see if it continues to pick up steam. If the dollar is going to pick up steam to the downside, I would say that is a bullish case that some of the international stocks, some of the gold, especially emerging markets, could really start to turn, and at the very least make a nice bear market rally. And we're going to look at that here in a second as well. But you can see that it's still in this zone. I mean, I don't know where a perfect spot would be to say now the dollar is in trouble. I kind of say you use this chart with other charts, but if it undercuts this 25 level, then we're like, huh, it's looking like it's going to take a deeper pullback, which would, in my opinion, open the door to a nice little rally in emerging markets and gold and things like that. So, you know, if I just go to another raw chart of emerging markets, look at this. Let me kind of move the volume below chart so we can kind of get that out of the way. But look right here. So now you have the last several days, the dollar has been weak and the emerging markets are strong. And this is just the EEM ETF. We're in a bear market. I mean, there's no question about that. And it's just been grinding its way lower. So that there's no pattern here other than a downtrend. But all I'm saying is, you know, you have these big legs down, and then you have a smaller leg down. See, it barely undercut that. And then you have kind of an even smaller undercut this time. So the momentum looks like it's somewhat slowing to the downside. I'm not telling you to go out and just back up the truck with emerging markets, but this is what happens, and the same is inverse on the upside. Like the length of the trend keeps getting shorter and shorter and shorter on the upside. That means the stock is tired. Same thing on the downside, keeps getting shorter and shorter and shorter on the downside. It means the stock is tired. So, or the momentum is slowing on the downside. So just kind of keep that in mind and always keep your eyes open, and don't ever write something off that is just untouchable because it might be a good play. I mean, look how many times this thing has got rejected at the 50-day moving average. That's a lot. That looks ugly. Let me look. See, China still looks ugly. That's all I have to say about that. Actually, I know what I want to do. Let me go to the individual sectors, and let's just kind of look at the spiders real quick. Let me look at a candle glance. Oh, chart book. There we go. Okay, so let's just look at the individual sectors. So you have sectors and then the industries. So the cyclicals, XLY. You want these to be up because those are your discretionary type of stocks, your discretionary ETF. But these are things people buy, recreational type stuff. But it's very strong, right? It's at an all-time high. It clearly is way above its January peak, unlike some of the other ETFs we're going to look at here in a second. So, that's a check mark to the bulls. Technology, again, is looking like the Nasdaq, right? It's just kind of grinding its way higher along that 50-day moving average. I'm not going to say it's neat and clean, but I mean, if you want something to be perfect and go straight up, I think you should probably stop watching this because you're in the wrong industry. But it is also way above its January high. Industrials have not reached their January high, so they are the weaker of discretionary and technology. So you're looking to put money to work. I still like technology. Materials definitely weak. This is just in a sideways trading range. It'd be interesting to see what this does if the dollar really weakens. But I mean, this is just nowhere close. It's going nowhere. There's better opportunity elsewhere. Energy is also looking interesting. You can see that it barely broke above its January high and then has just trended downwards along with all commodities. I mean, it is right there at the long-term moving average. You can see it touched it twice. If you like energy, I mean, you could easily put a stop under these levels. To me, I more would like to see what the individual stock looks like, but this is just kind of grinding lower. If you're going to pick something, why not pick something that's grinding higher instead of pick something that's grinding lower? Oh. Okay, so now you have consumer staples. They are starting to come back. You can see you had the golden cross right here, and the death cross right here. Now it's coming back. I mean, it is still way down, but this is probably one of the stronger trends in the last couple months with consumer staples. So, but that's broad participation. So I see nothing wrong with that, but that is a defensive play. Healthcare, the strongest out there, in my opinion. And this makes a lot of sense because I've been sending a lot of pre-revenue, a lot of biotechs that are just have, to me, very strong looking setups, more riskier plays, but the healthcare industry, the medical device sector, to me, this is the strongest pond to fish in, the strongest honey hole in the market right now, breaking down the healthcare sector into different things. You always want to fish in the strong, in the best pond, in the best honey hole. That's where I think it is. Utilities is also incredibly strong right now. After being, weak in a bear market, you had your golden cross right here, and it is, I wonder if I can get a bigger chart. That's just year to date, but it's a pretty strong trend upwards. So utilities are also looking strong. So we have staples that has made a nice rally since May, June. You have utilities that will also rally nicely, and most everything has, but defense has definitely not lagged. I'll put it that way. Probably one of the weakest with materials is financials, and I think that has to do with the way the yields have been moving. They kind of stopped going up, pulling back a little bit, kind of going sideways. So the financials have been struggling a little bit. I think there's very long-term opportunities in financials, but right now there is not a lot of love. It's nowhere close back to its January high. And that is all of them. Let's, so Nasdaq still stands pretty strong, giving up a little bit, that's fine. The Russell 2000 is down. Again, I just want to go back to know when it really starts to go against you, just get out of the way. Get out of the way, no matter what, it's fine. Get out of the way and, live to invest another day. Because if this, 78.50 level breaks, let's say you're in correction mode then, because then you didn't make a higher high, then all of a sudden you have a personality change. So just kind of keep that in mind, and I think in the next couple of weeks, you're either going to know. It's either going to continue to head higher, which you can take some profits into strength, or it's going to roll back over, then you're, raising cash. I want to... Give me just a second. I'm going to drag a chart over. I want to just kind of look at some charts that look interesting. I'm going to drag this over a little bit. Okay. So this is just kind of a chart list I put together. You have RGNX, very, very spotty sales. I don't know what this little guy is, but you know, it's what I'm seeing a lot in the biotechs is just some of the lower quality names that have pretty nice setups. But I just want to follow the theme of know where you're getting out, because this is a pretty, even after a nice move, look at the accumulation, low volume on the pullback, no distribution. No one's really getting rid of this thing. I mean, this thing just tripled, and I'm not really seeing any sellers stepping in. And it's building a bullish cup with handles, so you could easily say this is your entry, this is your entry. But I can tell you where, if it goes against you, you get out, and that's right there. You have a nice sideways, call it the 50-day moving average, or at the bottom of the handle. This could pick up steam to the downside very, very quickly. This has got a long ways to go, in my opinion, to the next line of support. So I just want to walk through some charts, and just because I think it's very important for you to walk through your own charts and know where you're getting out. This chart is a chart I've been sending to my subscribers for a few weeks now, and it looks incredibly interesting. CGNX, a weekly chart, daily chart, made a massive run, had to digest, but it's hard to argue what it's done recently. Big downtrend, then boom, all of a sudden earnings gap up, change of character. What is so interesting sometimes when these stocks gap up and they go nowhere, just sideways, no distribution whatsoever, and that's what you want to look at. Sure, you had one day, the next day, but that almost always happens after gap ups. But I mean, that is showing relative strength, and now it's back above its 200-day moving average. Excuse me, I have allergies, and it's kind of, I'm trying to work with it. Plus, I got a brand new cat, and he is distracting me a little bit. But that is a very, very interesting chart. Actually, let me go back and kind of look at the fundamentals. Very strong return on equity, year-over-year acceleration, consistent earnings, consistent sales, bullish breakout. Vertex, very strong. Now this is a high quality biotech, but very strong earnings. It does decelerate next year, but the recent revisions are upwards for earnings. Very strong return on equities. Most large cap biotechs do have strong return on equities. But it's interesting because you have this all-time high and it's grinding its way through it, but it is sitting right on that 50-day moving average, right on support. And since this gap up right here, gap up right there. I mean, I see one distribution day, but the volume has been so quiet and it's gone nowhere. And to me, that's an incredibly bullish sign. It means after all this buying pressure happened, pushed it up a little bit higher, no one's looking to really take profits. So is this an exciting swing trade that's going to pop, 20% in a couple of days? No, probably not. As a matter of fact, I seriously doubt it. But is this a good, something to put in your portfolio that could grind its way higher for a while? I do believe that. RHHBY, this is in the medical ethical drugs industry. Again, you have something that's been in a downtrend since 4.5 years. And now, here's what it's doing differently that it hasn't done in a while. So you have right here, it broke out above, the 40-week moving average, built a base, broke out, and then rolled over. Hasn't really done that since. Now it's doing it again. You broke out above the 40-week moving average, and it's building a base. So yes, this one failed, but look at all this accumulation right here. All these weekly spikes. That is not your grandma up the street. That is a couple big people stepping in and investing in this. And the supply is the demand is clearly there, and when the supply dries up, pushes up the price. This is a stock that has also intrigued me. The Keurig Dr. Pepper recently had, they combined companies, but you had these massive gap ups and then no activity, and then a massive gap up, and look at the breakout. It just broke out yesterday. No volume. Again, one might say, well, that's not very exciting. To me, that's incredibly exciting, because I do not want to see just chop up and spit out after a big move. I want to see something nice, neat, and orderly, and look how, I mean, it doesn't get any neater than that. Not huge volume on the breakout, but where I would get out is right under that low. You know, you're not that far away. Looks pretty bullish to me, and it's got a 9%, 9.5% dividend yield, 9.7. TCDA, this is another pre-revenue biotech. They are much, much riskier, but I want to go back to the shakeout rule. You have, calm down, kitty. You have classic shakeout rule, and I'm going to show you this pattern over and over because it continues to be one pattern I see with some in IPOs, mostly in IPOs, with some very, very profitable moves. So what happens is you got a quick breakout straight up from the bottom from a cut, right? It breaks out, and then all the market maker is selling you. The individual retails like you and me are buying right here, the traditional breakout zone, pushes down the price. So in other words, it creates that high handle. That 20-day moving average close to it, that is an ideal entry. Now, where are you getting out if it doesn't find support at the 20-day moving average? But I've seen more times than not when you have such a fast move. I mean, this went from 21 to 40. This doubled in a month, and now it's pulling back. I would be surprised if after such a strong move it does not find support. And then it might chop around a little bit before it takes off. Another shakeout, and this is Establishment Labs Medical Products. This actually stock has sales. Now this is a very small stock. This one's actually very thinly traded today, but mostly about 50,000 shares. But look, it broke out, went from 24 to 30 very, very quickly, and then came back under the pivot. Now, it didn't find support right at the 20-day moving average, but I bet it does kind of build a little base right here, and if it kind of chops sideways a little bit, you could put a buy stop order as it's crossing that to take its next leg up. So it's in a bullish industry, or else I wouldn't be showing you this. ALLK, I sent everybody this morning. Disclosure, I do own some shares in this, but it also is thinly traded. But again, you have a bullish move from the bottom, breaking straight out, shakes you out, kind of brings you back to that 20-day moving average, and is now trying to grind its way back higher. So you have a thin biotech stock, pre-revenue. I know it's risky, so I'm not telling you to go out and buy these things. I'm more trying to show you the setup, but I sent this out to everybody with the chart just to show you this setup is a profitable setup. And it's a very simple rule. When you see the pattern, when you see it move like 30 to 40% very quickly to break out of a traditional all-time high, then it shakes you out, comes back, comes within 5% of the 20-day moving average. That's your ideal entry. If it doesn't find support, you get out. I mean, you could buy within the 5%, and by the end of the day it closes below, you can get out same day. I know that sucks. It's happened to me before, but defense wins championships. I don't mean to be cliche, but it does. Trivago also continues to, I'm going to switch charts because for some odd reason Trivago is very hard to see on this. Trivago 2. So look, this stock has went from 24 way up here to 4. It's in a first stage consolidation. Now, does it take another step down? I don't know, but it is now really consolidating above the 50-day moving average. That's a character change. That's a personality change. if this is truly, if it finds support here and grinds its way higher, what an excellent entry for a long-term trade. Now, it could report earnings and just roll over and wreck everybody's day. And you always like when I throw in disclosures like that. But I'm just saying, when you see the personality changes, I've been watching the stock forever because I see their commercials all the time, every day. Trivago this, Trivago that, hotel. And I look at the stock, I'm like, how is the stock doing so bad when they're advertising so aggressively? Maybe they got overextended, maybe the valuation definitely got overextended. But now it is just doing something different. So easily, the 440, if it breaks the 50-day moving average, I mean, you can get out, right? Like I try to find positions, and hence the weekly reversal pattern. I try to find growth stocks and try to get in at very good points where I feel it's very, very early in the move. Yes, there's sometimes a bigger risk for that, but of a shakeout. But man, I think the reward is definitely worth it. So I hope this webinar was helpful. Again, I hope if you took away something from this, it's really, really know what your game plan is. If the market does all of a sudden become not so bullish, which I know it's hard to remember what a bear market was like, but we could most certainly have one someday. So just know where you're getting out. Don't be complacent. Don't average down if it's starting to break support.